Hey, what's going on, everyone? Christian Carter here, and today we're talking about cash to close, right? So cash to close is a real common term. It gets thrown around a lot, but it's essentially made up of three different items, right? So cash to close is made up of your down payment, it's made up of your closing costs, and then it's also made up of prepaid items, okay? So whenever you hear the term cash to close, it's basically the lump sum of those three items, right? And we're going to break those down real quickly. So first one, your down payment. So how much of a down payment are you making for the purchase of this new property, right? Some people do 3%, 3.5%, 20%. So whatever your down payment is going to be, that's going to be part of your cash to close. Real quick example. So let's say you're making a 3.5% down payment, right? So you're going to take your purchase price of $100,000. You're going to multiply that by 0.035, because that's 3.5%, and you come up with $3,500, right? So for this example, your 3.5% down payment on a $100,000 purchase price, it's going to be $3,500, right? All right, moving on to closing costs, right? So think of closing costs just like it sounds, right? These are costs that it takes to close the actual loan. The big ones are going to be lender fees, so that's us, the bank, the mortgage company, lender fees and attorney fees, right? So part of these closing costs, I just kind of hit the big ones here. You've got a credit report fee, you've got appraisal, origination fee. So these are basically bank or lender fees, right? And then these last ones are going to be more attorney fees. So title settlement fee, title lender's policy, recording fee. Basically closing costs, just like I said, they're what it costs to close the actual loan, right? So think lender fees and think attorney fees. And then lastly, prepaid items. Also, just like it sounds, those are items that you prepay, right? So for example, you're going to pay a year's worth of homeowner's insurance up front, right? That's to get your escrow account started. And then you're going to pay a couple months worth of real estate taxes, right? In order to get that, again, that escrow account started. And then there's another one, very small, but prepaid interest. Let's say you close on the 15th of the month. You're going to pay a little bit of interest from basically the 15th to the end of that month, right? It's just going to cover that small period. So that's prepaid interest. If you were to buy a home on a Monday and then you sell that home for whatever reason on a Friday, you would get the vast majority, you would get pretty much all your prepaid items back, right? However, you wouldn't get any of your closing costs back. I hope that makes sense. So essentially, cash to close, whenever you hear the term cash to close getting thrown around, just know that it's made up of three different things, right? Down payment, closing costs, and prepaid items. I hope this helped. And, as always, reach out if you have any questions. See ya.